Okay, so here we have the model. Well, let's just explain some stuff here. This is the mortgage rate. This is the line of credit rate. This is your loan amount of your mortgage. This is your number of periods. Well, 30 years. This is the years. Don't get that confused with months. Um, this is your income, expenses, your excess cash flow. That's your net income. Your take home, your after taxes. Everything here is after taxes. Taxes are not part of the argument over here. This is the the market investment rate, and this is nothing. So in order to model this, what we have to do is you have to amortize the line of credit. So I wrote a formula here to find the line of credit amount that it would basically take 10 years. I can read the formula. It's about 12. This is your 10 years. This is your excess cash flow. Pay off to zero. Fine. Too nerdy. This is the amount this is your line of credit amount that you can pay off in 10 periods, including interest. So it's not $5,000. So it's times 10 because of the interest. And it actually doesn't, I couldn't get it to line up exactly with zero over here. Um, have a zero amount as balance, but the formula still works. There's still 10 payments of interest before it gets to negative territory, and that's all the formula cares about. I made a mortgage amortization schedule with the line of credit extra principal. Um, you can use the formula if you can, which I don't care. I'm not going to explain that. That's not the point. Here's your extra principal um, example, and here's your regular example with no extra principal. And I have done the work for you. This is the months till finished the regular mortgage because it's 12 months a year times 30 is 360. This is how many months it takes to the pay mortgage with extra principal and with the line of credit. You'll see that the extra principal takes three fewer months to finish paying, and it has lower interest paid over less time. Of course, the regular the regular mortgage has tons of interest paid over time. But here's the kicker: if you are saving your if you are investing the money saved if you didn't pay the extra payment and you put it into the stock market, assuming a 8% average rate of return, assuming no volatility, which there is volatility, but you have 30 years to worry about volatility, so we're not worried. You would end up with $750,000 at the end of those 30 years. And what this does, these two do the same thing with the stock, except they start after the months to finish. So this has 3 more months to pay into the stock market. Plus, after you finish paying off your mortgage early, you can include the mortgage payment, which now you don't have to pay. You dump that into the stock market. That's the only way to do a fair analysis. And so these have lower stock market numbers, but if you do the net at 7% with these terms, it's important to say with these terms because all of these terms make a difference. With these terms, extra principal payment wins. Let's change this percentage. If you bought your house before or during COVID, oh, sorry, not 0.3%, 3%, 3% lower mortgage rate. Therefore, the mortgage wins because you're not paying through the teeth, through the nose, And therefore, adding also the stock market, this gets double. Let's put it back to 7. Let's say we have $200 of money to play with. We have net zero because we paid more interest than we have from the stock market. But the most money we have, the winner is the greatest number is the lowest negative of extra principal paid. Let's lower this number so we don't have to look at negatives. And here you go. The line of credit never wins because you're trading lump sum of your excess cash flow to the beginning of the period. Let's say, just for the sake of argument, let's say we're going to pull that to the side. Actually, that's not going to help. I'm going to copy this formula, dump it over here, and make this equals that times 10. If we do that, so we're not doing interest, but now that we have more line of credit, it takes 11 periods to pay off, right? So doing the full 10 times the amount just made us take longer to pay off the more money. So that one more month of waiting till we can recycle the line of credit means that it's still losing the game to the extra principal payment. It's a fine mathematical difference, but this is like a weird scheme that I didn't come up with, so don't blame me. But if you're going to invest the money, extra principal payment works, unless if you have a 3% mortgage, especially with a greater loan amount. I'm not sure why the number is still land. Then you want to do the regular mortgage and put your money into the stock market. Now, of course, the stock market can crash in the last 3 years of your mortgage. That's not the argument here. You would have to wait till it recovers or sell beforehand or whatever. You would have to be smarter about that. Um, One more point I wanted to make was, um, what was it? Oh, yes. I haven't shown what happens if we only invest. I mentioned this in the voice note, I think. What happens, what if we only invest our extra principal payment during the years or months when our bang for our buck is massive, is 20%. And I'm not even going to model it, but I'm going to bet that you're still going to lose. Why? As I explained in the voice note, I believe, unless I'm hallucinating what I said, because I thought about it before I said it. I might have just thought about it. That 20% is not being compounded. It's being made once, and it's not cash flowing. You're not making back. You're just saving the interest. You're skipping ahead in the schedule. So you're only going to have that money in your pocket when you're done the mortgage, and by that time, the growth that you would have gotten the stock market would have compounded over and over and over 8%, which would have been more than your 20% at the most 20%. And that's why at you need to put in your information. You could take this, I don't care. I'm not sharing it, but I clicked on enough stuff here that you can probably do this yourself. I didn't show you all these stuff, whatever. You can figure it out if you want to. But I'm not a I'm not a CFA or anything, so don't sue me. Do this at your own expense, at your own risk. I'm just showing you what I have discovered. Thanks. Bye.